and welcome to Macros with Mythili, the ET Now show that takes a hard look at all the major macroeconomic issues and developments in India and overseas. In this edition, we are going to turn the spotlight on the RBI's recent monetary policy announcement, the penultimate one for this fiscal before its last announcement after the budget in February 2019. And perhaps the very first where interest in the MPC meeting was relatively muted compared to interest in the forthcoming meeting of the RBI Central Board on the 14th of December. Of course, the fact that not much was expected by way of policy action, and in the event nothing much really happened, was also part of the reason. But when it comes to the Reserve Bank of India and its statements, sometimes silence speaks louder than words. So that's what we're going to focus on in this discussion with our panel of experts. Obik Barua, Chief Economist and Executive Vice President, HDFC Bank, and Saugata Bhattacharya, Chief Economist and Executive Vice President, Axis Bank. Welcome to the show, Obik, Saugata.
Thank you.
So let me instead start by asking both of you in turn, was there anything in the RBI statement that really surprised you? We'll go into the details a little later, but at the broad brush level, was there anything at all that made you raise your eyebrows? Let me start with you, Obik.
Well, the one thing where I have some disagreement with the RBI is on the growth number. They've talked about an increase in the seasonally adjusted capacity utilization rate for companies, which points to some investment activity capex, which is also there in the GDP numbers. If you notice, the quarterly GDP numbers have shown double-digit growth for about 4 quarters. I don't see signs of that, or enough signs of that, on the ground as far as private capex is concerned. So I am a little concerned about that. I also sort of disagree with the RBI's characterization of the current growth trajectory as one where there will be a pickup going forward. I think there are signs of slowdown starting with the Q2 GDP numbers, and I would bet on both a slowdown in the next 2 quarters in terms of the headline numbers as well as the underlying nitty-gritty, and the possibility of the RBI having to pair its GDP forecast that it kept unchanged at 7.4% yesterday.
Okay, Saugata, was there anything that you were surprised by? And I must warn you that if you agree with Obik, you'll go down in history as perhaps a rare economist who actually agreed with another economist. Saugata?
I completely agree with Obik. There are quite a few surprises that I actually saw in the policy. Not so much on the rates or the stance, but on the numbers, the forecasts, one. So growth, our own sense is that growth in the full FY19 is likely to slow down to about 7 to 7.1.
Okay.
We expect a fairly deep slowdown in Q3.
Okay.
And secondly, even the inflation forecasts, the revised inflation forecasts, I think are on the lower side now. Okay. So I think they have compensated a little bit more from the previous forecast, and our own forecast seem to suggest it's still within the band that the Reserve Bank the MPC has given, but it's on the higher side. Okay. So I have a feeling that inflation, actually the midpoint, our own forecast will be higher than the midpoint.
Okay.
Thirdly, a very large announcement, not so much in the policy, but has deep implications for transmission, for etc., was the switch of pricing, bank loan pricing, to market benchmarks away from the MCLR. Okay. That actually came in as a bit of a surprise, and this has significant implications.
Okay, let's now get down to the basics, starting with inflation, which is perhaps the sole mandate of the MPC. So Wednesday's statement saw a sharp downward revision in the RBI's inflation projections for the next half year, from its October projection of 3.9 to 4.5% to 2.7 to 3.2%, just 2 months after the last statement in October, even as the actual inflation number has repeatedly surprised in the downside. Granted, hindsight is always 20/20. Also granted that when global oil prices are as volatile as they are now, it's very difficult for any central bank to make an accurate assessment. That could explain one instance of the RBI's estimates going off the mark. But when you look at the bank's estimates that are repeatedly off the mark and in one direction, with actual inflation repeatedly undershooting its estimates, does it show the bank in poor light, Obik?
Well, I mean, I think there is a problem with the RBI's forecast model. And I think this is, come under heavy fire from a number of economists in the past. But I think the inflation trajectory of the last few months, particularly the trajectory of food inflation, has been quite startling, really, because we've seen deflation and a complete breakdown of the kind of seasonal patterns that we've seen in the past in food articles. And of course, there's been this enduring volatility in oil prices and so forth. So I think I would give the RBI a little break on this, but this doesn't take away from the fact that they might want to take a fresh look at the forecast model. But what it has effectively led to is perhaps stickier rates in the past than the situation warranted, and in order to prevent policy errors of this kind in the future, they might want to recalibrate their forecast model. But again, I'd like to emphasize that the inflation patterns in the last 3 or 4 months have been very, very, as I said, startling, because it was, it's been way below expectations, and also volatile because of the international situation.
Yes, I'm sure you would agree with Saugata, with Obik on that, though I myself am also inclined to be a little less charitable, because while I agree that the sharp and unexpected dip in oil prices is responsible for the abnormally low inflation that we are seeing today, I'm not sure the bank can be excused for not seeing through the fact that the much lower impact of the hike in minimum support prices in a scenario where procurement is so limited in the country. Also, it's not the first time, as I mentioned to Obik. So my question to you is, has the shift to inflation targeting led us to an inbuilt bias of seeing larger than warranted inflation pressures, at least as far as the MPC is concerned? Saugata?
So yes, I mean, you're absolutely right that, I mean, it's not just the Reserve Bank. I mean, all of us, and even today, I have to admit that I do not understand the price formation dynamics for food prices. We heard the explanation yesterday that the government was selling out of its stocks, which is fine to a certain extent. But I mean, I think overall, the apparently changed structural dynamics of food price inflation is really difficult to enunciate. I don't think even a tweaking of the models, the analytic models, the statistical models will address this problem. So that's something which needs to be understood, the price formation dynamics of agricultural food, agricultural prices in particular. But given this, the only alternative is to keep your policy stance and rates stable, look for a little bit on how things move over a period of time, and then tweak a liquidity in the markets to try to adjust overnight and short-term interest rates for them to act as an effective transmission mechanism into market and loan rates.
Okay, so now let me turn to growth. The statement says that growth slowed down in Q2. Is that your assessment too, Obik? Also, given the widespread belief that growth in the second half year is likely to be slower due to the base effect, at least, of the higher growth in the comparable period last year, and also slower global growth, does the bank's action in keeping its GDP estimate for the year unchanged at 7.4 seem a little inconsistent? You spoke, Obik, of the fact that the bank seemed to think that H2 would be better, but is there not some inconsistency, Obik?
No, as I said right at the outset, that I disagree with the RBI's assessment of growth prospects, and I think this was echoed by Shogoto. I think we are looking at a slowdown certainly in Q3 and possibly also in Q4. In terms of just the numbers, there's an adverse base effect that will pull the numbers down. But the question then reduces to whether the RBI should have taken the lowered inflation forecast and put out more realistic growth numbers and gone for at least a change in stance that would pave the way for a rate cut going forward, perhaps in the next policy. I am kind of conflicted in taking a very definitive stand on this. I think it's difficult to keep changing your stance from one policy to another, especially in the light of so much volatility in the international situation. I think we should do away, partially or play down the, phrases like stance and so on, and get a little more flexibility back in the system to nimbly respond to things as they pan out. And that was the case earlier before we had this the change in the inflation targeting model and structure. But on the question of growth that you raised, I think there is certainly some cause for disagreeing significantly with the RBI.
Oh yes, it's a tough call in any case. But Saugata, if you were to list all the reasons why GDP growth could touch that 7.4% this year, what would they be? And on the flip side, what could be the possible risks to achieving that growth, Saugata?
So one, you again, from the arguments put forth by the Reserve Bank that the drop in oil prices opens up significant space for discretionary incomes to rise, for consumption to rise, a little bit of investment for cash flows to corporates, investment becomes a possibility. That's the thinking. In addition, I mean, even in the rest of 2018 and going into early 2019, global growth still remains relatively stable and modest. And any slowdown, global slowdown, will only start kicking in the latter half of 2019. So I presume that's the argument that the MPC came out with for retaining the growth outlook. But I mean, with credit flows and then on top of that, bank credit looking to compensate the slowdown in NBFC credit offtake is yet another reason for keeping the investment outlook relatively stable. But given everything that we have seen on the ground, it does seem as if the overall fund flows for credit are likely to come down. Banks will not be able to compensate for the model, the last mile lending model that the NBFCs used to do. So the banks will not be able to compensate for that. And given this is likely to hit consumption. In addition, I think you will see significant liquidity tightening in the second half, as a result of which cost of funds is likely to go up. So that's likely to crimp investment activity a little bit. Is our contrary thinking that the headwinds that we will see in H2 are likely to offset any tailwinds that come in from lower oil and commodity prices.
Oh yes, headwinds, tailwinds. But now that we've got both growth and inflation out of the way, it's time for us to take a very short break. But we'll soon be back to discuss the rest of the things that the statement addressed or did not address. Welcome back. You're watching Macros with Mythili, and I'm in discussion with Obik Barua and Saugata Bhattacharya on the RBI's latest monetary policy statement. And we're going to read between the lines to see exactly what the policy said and maybe what it left unsaid. Well, as I said before the break, we've got inflation and growth out of the way. So now it's time for us to look at the next big elephant in the room, which is really liquidity. And I'm not going to ask you the usual question of whether or not there is enough liquidity. My question is rather regarding a rather surprising response, to my mind at least, from the Governor Urjit Patel to the question in the press conference about whether the MPC had discussed using the CRR, the cash reserve ratio tool, to ease liquidity. To which the Governor responded rather surprisingly that CRR is not in the mandate of the MPC. Given the close link between liquidity and interest rates and the fact that the MPC uses interest rates as a tool to target inflation, are you as puzzled as I am by the Governor's response, Obik?
No, I'm certainly not as puzzled as you are, because I think if you've been following the last few monetary policy statements, liquidity management is strictly outside the mandate of the MPC. Now, whether this is the right way of doing things or not is a different question. But clearly what we've seen is that the MPC's views are largely on the repo rate and associated rates, while the liquidity issues are discussed in the press conference as sort of distinct from what the MPC had discussed. On the specific issue of the CRR, I think the market should have got sensitized by now that the RBI's liquidity management model or paradigm, if you like a more fancy word, it has moved away from the use of the reserve ratios to market determined methods, particularly the use of open market operations and so on, term repos. And so I don't think either of them came as a surprise to me. I think people who were, and there were some who were asking for a CRR reduction, were also simultaneously asking for a complete change in the RBI's model of liquidity management as it has emerged over the last 2 or 3 years. Is there enough liquidity in the system? Clearly not. But I think we got a categorical assurance from Dr. Acharya that he would sort of put in liquidity, adequate liquidity in the system. Whether adequate means, zero repo borrowings is a question that we need to sort of grapple with. I personally think that liquidity will be short, as it usually is in the second half of the year, given traditional seasonal patterns and the fact that there is a lot of borrowing. But I think we will not have a liquidity deficit of the magnitude that we saw around the NBFC crisis and so on. And the RBI has been quite nimble in using the open market operation. Again, emphasis on the fact that these are market-linked liquidity management measures, and sort of liquefying the system to some degree. More is coming the market's way.
Shogato, do you buy Orbik's explanation, perhaps rationalizing the governor's response to that question on CRR? Because to my mind, even if the MPC was looking only at the repo rate, you really cannot look at the two separately, because liquidity plays a very crucial role in determining what the interest rate in the environment is. Also, my second question is that even if there is, as the Deputy Governor assured, adequate liquidity at the systemic level, should the RBI as a central banker and also the regulator and supervisor of banks be indifferent to the sectoral needs for liquidity? Shogato?
Sorry, Mythili, I couldn't understand your second question, but let me tackle the first one. I'm completely, number one, first, I'm totally in sync with you that liquidity management is inextricably linked with setting interest rates, which is the primary responsibility of monetary policy. So, I mean, you cannot separate the two together. Secondly, I'm of a somewhat different opinion from both you and Abhik on the CRR. So the CRR might or might not be a monetary policy tool, but it definitely is a liquidity tool, and as part of liquidity management, and the RBI has shown that it is managing liquidity on a continual basis. I mean, it's not just a once in 2 months, etc. So deploying all the instruments that it has, whether it be SLR, whether it be LCR, the fall CR response, whether it be OMOs, whether it be term repos. So it is managing liquidity on a continual basis. The CRR is certainly one of the most durable forms of liquidity that can be infused in the system. But the OMOs, I think, is a dual system to infuse both liquidity and manage the shape of the interest rate curve, the yield curve. So I think in an environment where you're trying to push down corporate bonds and market interest rates, I think OMOs might actually be a preferable option compared to a CRR cut. Third, I think CRR, because of various issues related to market stability, financial stability, this is the last buffer that is available to banks. So in an environment where there is so much uncertainty, it might be a good idea to keep that buffer, that absorptive buffer in place, and use other instruments to manage liquidity. Fourth, last, giving system liquidity probably is still not adequate to transfer system liquidity into operational sector-specific liquidity. And I think some of the other measures might or might not work, but that's something, in case of a credit squeeze in certain sectors, the RBI might want to respond with some additional measures.
Well, you addressed my second question, Shogato, which is precisely about the sectoral deficits in liquidity. But Abhi, now let me just turn to the banking sector. The fact is that after months of debate and in fact vehement opposition from the commercial banks, the RBI has now decided to insist upon use of external benchmarks to price loans to the retail sector and MSMEs starting from 1st of April next year. This is based on the recommendation of a committee that actually submitted its report way back in October 2017 and was criticized even then by the IBA and by all the banks for consisting only of RBI officials, not including a single practicing banker, and coming out with very textbookish theoretical solutions. Do you see this, as I do, as another example of RBI's micromanagement? Shouldn't loan pricing be left to be decided by free market forces, especially now that banking is no longer a closed sector, and RBI's role should really be limited to insisting upon transparency? Obik.
No, I will have to wear two hats in answering this question. As a banker, I think there are problems with, I see certain problems with using an external benchmark for liquidity. Having said that, I think over a period of time, we have been sensitized to the possibility of more, market linkage of lending rates, so that transmission of monetary policy becomes more effective, and hence the move to the base rates, then to the MCLR, then some harmonization of the MCLR and so on. I think there has been an enduring concern about the fact that the RBI's policy rate changes do not translate into rate changes on the ground. And from that perspective, I think this makes sense, although it might have some impact on interest margins of banks. My sense is that, we've been, as banks, we've been aware of this possibility for a fairly long time. The fact that it has finally been announced comes as a mild surprise, but not as a huge shock to us. The only thing that I would insist on, and this is a problem that arose with both the base rate and the MCLR, was a divergence across banks in pricing, in their pricing formula, even though the broad umbrella of MCLR or the base rate operated. I think we should ensure that for the same asset class, banks use the same benchmark, so that there is no large divergence across banks in pricing some of their loans, because that leads to unnecessary confusion and is unfair to some banks and favors certain other banks. So uniformity and harmonization of the lending rate benchmark for the same asset class is a must.
Shogotu, would you agree with Obik? After all, nobody insists that automobile manufacturers should price their models based on a common benchmark.
Yes and no. Again, I'm talking from an economist's point of view. So, from there, the broad top-level objective are to enforce transparency and improve transmission. That's the ostensible reason for moving to a market benchmark. But there are so many operational problems with this. So first, with banks' assets, all the loans that banks give will automatically then now move, the retail and SME loans will move to the new market benchmarks, whatever the benchmark that is finally decided. But on the other side, the bank's liabilities, particularly the CASA deposits, which is a significant part of total deposits in the system, and to a certain extent even retail term deposits, these are more or less much more sticky than market rates. So it is a challenge for banks to try to match the tenor and asset ALMs of the assets and the liabilities. So much better liability management, ALM management will be needed to understand the patterns of movement. So that's one. But together with this, on a more systemic basis, I think there are significant advantages if you read the market benchmark move together with the working capital move. I think this is likely to introduce much more market and credit discipline, not just amongst banks, but even amongst corporates. in order to manage their liquidity, in order to match their asset liability mismatches. Much better, induce credit discipline. Okay. I think overall, I'm sure I'm going to get a lot of flack on this, but overall, I think we should be gradually moving to some such system, keeping in mind the specific peculiarities of the Indian deposit system.
Oh yes, it's going to be a tall order in the short run, but maybe desirable in the long term. But before I close this program, Obik, I just want to ask you one last question. Is the RBI's problem really its tendency to see everything in silos, thereby sometimes missing the big picture? Take, for instance, this crackdown on NPAs. Desirable as this is, the fallout of its haste to clean up bank balance sheets after years of forbearance, including by the RBI itself, resulted in banks turning risk-averse, withdrawing from lending, and as a result, not only did credit to the productive sectors dry up, we also saw borrowers turn to NBFCs in a very big way, with the resultant excesses that we're now seeing in the NBFC sector, very similar to what we saw at the banks in the boom years. Given that RBI is a regulator for both banks and NBFCs, we would have expected the bank to look beyond the immediate impact of its action. But I think that was missing. Would you agree, Obik?
No, well, yes and no. I think for one, I think what has been described as a spat or a squabble between the Finance Ministry and the RBI is actually the subject of a serious intellectual debate on various issues like in the amount of capital to hold, the kind of macroprudential norms that you would use for certain sectors. And so I think we should see this as part of a serious intellectual debate rather than a difference of opinion between individuals. Having said that, I think the RBI has overcompensated in terms of jettisoning discretion in favor of rules. But for a regulator which has kind of messed up a little in the past, this is perhaps natural.
Saugata, would you agree that the RBI needs to get out of this habit of looking at things in silos?
It's difficult to answer this directly, but I certainly agree with you that a more systemic perspective is probably required given the interconnections between the various lending segments, whether it be CP markets, the mutual funds, the NBFC segments, banks, public sector banks, the government, whatever. I think a more systemic view, particularly inter-regulatory coordination, I think is required at this point in time.
Oh, certainly. Well said, Saugata. So what we really need is a systemic overview and a look at the larger picture as well. Thank you so much, Saugata and Obik, for joining me in this discussion and throwing light on the RBI's monetary policy statement. Thank you also for watching. Remember, we'll be back next week with yet another edition of Macros with Mythili. Till then, it's thank you and goodbye from all of us at ET Now.